Hi guys, welcome to Reinvesting. Today we're going to be discussing how to invest in stocks and also other topics that might be beneficial to you. Stock investing has been accessible in recent years with newcomers able to start an account with minimal money via brokerage websites or mobile apps. A stock symbolizes a common shareholder's ownership position in a corporation. Shareholders of common stocks can vote on a corporate matters, with most corporations allowing one vote per share. Some corporations also pay dividends to stockholders, providing a source of income in addition to the stock's market value. These payments are usually adjusted according on the company's profitability. Stocks are a high-risk asset that may help an investment portfolio and provide income. This indicates that it is an asset class with a high level of price volatility. When it comes to equities, novice investors must assess their risk tolerance. In general, the higher the risk, the higher the possible payoff. However, investors must be ready to risk losing money if big returns do not materialize. Stocks have a proven track record of delivering good yearly average returns over time. The first step is for you to open a brokerage account. You need this to account to access investments in the stock market. The next step is to fund your brokerage account by transferring money from your bank account to fill trade of stocks you want to buy. The amount of money you choose to invest depends on your risk tolerance, goals, and how much money you're comfortable potentially losing. Remember that over time, the stock market typically increases in value. There can be short-term market fluctuations, which can put your money at risk. So how much money should you put into the stock market when you first start? Several online brokers, including Betterment, don't change fees if you have no money in your account. And don't demand a minimum deposit to create a trading account. You may begin investing with any amount with these brokerages. Some companies also sell fractional shares, which means you don't have to buy a complete share if you can't afford it for the moment. Whole shares of Amazon.com, for example, cost more than $3,000 in earlier 2022. Thus, fractional shares make the stock more accessible to the general public. Have a plan for investing, especially when markets are volatile. The stock market is prone to periods of extreme volatility. Stocks, particularly those bought, generally secure face price changes at these times. This can happen when there is market uncertainty and is usually short-lived. Volatility may be frightening, especially if you are a novice who hasn't dealt with it previously. Having said that, you should invest in firms that can continuously expand their sales and earnings over time. You have faith in the firm even if the stock price fluctuates. When investors believe in the firm and the stock price drops, they may perceive this as a chance to acquire more at a lower price. You may learn about how organizations and sectors are performing by looking at their metrics. Whether price earnings or price sales ratios are high, for example, We may tell when specific stocks or sectors are priced in bubble tier. When it comes to stock selection, valuation is crucial. When determining whether a company is cheap or overpriced, investors must analyze criteria such as profitability, earnings growth potential, management quality, and industry performance. Stock prices, according to Beckerman, provide investors some insight into the mood towards specific sector groupings. Stock investment offers two methods to profit: selling shares when their market value rises, and receiving dividend payments. Dividends are payments paid by a firm to its shareholders in cash or shares on a monthly, quarterly, or yearly basis. Dividends are a mechanism for a publicly listed corporation to distribute its profits to its shareholders, investors. Investors who seek a consistent source of income from their stock portfolios should look for firms that pay for dividends. Dividends are seen as a stable source of revenue since they may be paid out even if the firm is not profitable. Dividends can be used as an income or reinvested for a higher long-term return. Many dividend equities have a proven track record of healthy cash flows, low debt, and attractive yield. Dividend stocks are an important part of any income investor's portfolio, but they're not just for retirees. Dividend stocks have a place in each portfolio, regardless of the age or financial situation of the investor. Compounding is the cause. When these equities and dividends are reinvested, an investor's wealth grows exponentially. You will own more shares if you reinvest your dividends, and the more shares you possess, the bigger future payouts will be. Since 1930, dividend reinvestment has accounted for more than 40% of the S&P 500 average yearly return. At the time, there's a lot that can go wrong for dividend stock investors, from picking firms with unreliable income to focusing solely on the dividend yield. Today's dividend investor must concentrate on the company's ability to provide a discretionary dividend payment. Now let's get into what is a dividend. A dividend is a portion of a company's profits paid to shareholders on a quarterly basis, similar to a bonus to investors. Dividends are a mechanism for shareholders to participate in and benefit from the underlying business's development in addition to the share price rise. This wealth distribution might take two forms: cash dividends or equity dividends. The majority of dividends paid in the United States are cash dividends, which are cash payments provided to investors on a per-share basis. If a corporation pays a 20-cent dividend per share, for example, an owner with 100 shares would get $20 in cash. Stock dividends are an increase in the number of shares owned by a percentage. If an owner has 100% shares and the corporation pays out a 10% dividend, the investor will finish up with 110 shares. Dividends aren't a given. They're at the board of directors' discretion. Unlike a bond, which must pay a certain amount or face default, the board of directors can lower or even remove the dividend at any moment. While no dividend is guaranteed, some are more important than others. Preferred stockholders have a greater claim on the company's assets than regular stockholders, but a lesser claim than bondholders. If a corporation is obliged to reduce its dividends, It begins at the bottom and works its way up. It will pay creditors first, then preferred shareholders, and then regular shareholders if there is any money left over. In good times, companies employ the same hierarchy to decide how to distribute cash. Preferred shareholders are frequently paid first and get a higher dividend than regular stockholders. The special dividend is another sort of payout. Special dividends are extra payout on top of your regular payouts. They are one-time dividend payments that firm could make after a particularly successful quarter or if it wishes to modify its financial structure. Extra dividends are often paid in cash and are typically bigger than ordinary dividend payouts. Why do investors buy dividend stocks? Well, despite the fact that dividends aren't guaranteed, many investors rely on them for income. Because firms pay dividends at different times, retirees can set up a dividend payment plan for each month of the year. Younger investors who may not require the income right now can reinvest their dividends and put them to work right away in their portfolios. Even if you use dividend reinvestment programs to automate this procedure, your payouts are still taxed in the year you receive them. Dividends in a tax advantage account, such as an individual retirement plan, are an exception because the money grows tax-free until it is withdrawn. When interest rates are low, dividend stocks frequently provide larger yields than bonds, while also providing the possibility of share price increase. Even if the price decreases, the dividend may provide a consistent income stream to a portfolio. And if you reinvest the dividends, a lower share price buys you additional dividend shares. Now, if you're wondering why do businesses pay dividends, dividends are often regarded as a sign of financial strength. Therefore, a firm may pay them to attract investors and raise the stock price. A corporation that pledges to pay a dividend is likely to be a higher quality and more stable. Companies often pay dividends when there is money left over after operating expenditures and company investments. As a result, established enterprises are more likely to pay a dividend since they require less capital reinvestment. As a result, they begin to increase their annual dividend in order to distribute their earnings to their shareholders. Now, if you're wondering how to pick the best dividend stocks to invest in, the dividend yield or the yearly payout per share by the share price is a popular point for these investments. The yield is the amount of income received by investors for every dollar invested in the stock. A 3% dividend yield, for example, would be a company selling at $100 per share and paying a $3 dividend to you, providing you 3 cents in income for every dollar invested at the $100 shares price. The dividend is typically seen to be independent from the stock market's ups and downs, but the two are actually more intertwined than most people know. The share price and dividend yield fluctuate in opposing directions. The dividend yield will grow if the stock price decreases, as it typically happens when a firm is in financial distress. Investors who focus solely on the dividend yield risk missing the overall picture. What we truly desire is a mix of increased principal, increased income. The increase in share price and dividends paid is known as a total return. Investors looking for high total return possibilities should analyze what allows a company's business to expand so that its dividend grows as well. This may appear intimidating, but the procedure is similar to applying for a mortgage with a bank. Investors may analyze a company's financial accounts to see how it supports the dividend and if it can afford to continue paying it, just like a lender looks at your bank statements and pay stub to see how much money is coming in. And if you can afford to pay your mortgage, how much should you invest in dividend stocks? The percentage of portfolio you should allocate to a dividend strategy is determined by your risk tolerance, investment time frame, and income needs. Remember, dividend stocks are unlike bonds, which guarantee your money back. Dividend equities, like any other stocks, are vulnerable to market and company specific risks. Dividend equities are also subject to interest rate risk. Investors may abandon dividend stocks for the guaranteed income of bonds when interest rates increase, causing stock values to decrease. Happen right after a session of moderate vigorous physical activity. Benefits include: what is a money market? Money market refers to a segment of the financial market that trades financial securities with high liquidity and short maturities. The money market has evolved into a segment of the financial market for the purchase and sale of short-term securities, such as treasury bills and commercial papers, with maturities of 1 year or less. Over-the-counter trading is a wholesale operation that takes place in the money market. Participants utilize it to borrow and lend money for a brief period of time. Treasury bills, commercial papers, and certificates of deposit are examples of negotiable instruments in the money market. Many participants, including businesses, utilize it to raise money by selling commercial papers on the market. Because of the great liquidity of assets, the money market is regarded a secure area to invest. Investors should be mindful of several dangers, one of which is default on instruments such as commercial papers. The money market is made up of a number of financial organizations and dealers looking to borrow or lend assets. It is the ideal place to put your money in liquid assets. The money market is an uncontrolled and unstructured market. Unlike the capital markets, which are structured in a formal manner, money markets provide a lower rate of return to investors, but they do offer a wide range of goods. It is simpler to withdraw money from the money market. Money markets vary from capital markets in that they utilize for a shorter time period, whereas capital markets are used for longer periods of time. Meanwhile, a mortgage lender can mitigate the danger of a fallout by entering into an arrangement with an agency or a private conduit for operational delivery of the mortgage rather than required delivery. In this case, a mortgage originator effectively purchases an option, giving the lender the right but not the duty to fulfill the mortgage. The private conduit, on the other hand, charges a fee for permitting optional delivery. Understanding the money market. One of the cornerstones of the global financial system is the money market. It entails massive overnight transfers between banks and the U.S. government. Wholesale transactions between financial institutions and businesses account for the bulk of money market transactions. Banks that lend to one another and large companies in the euro currency and time deposit markets, companies that raise money by selling commercial market into the market, which can be bought by other companies or funds, and investors who buy bank CDs as a safe place to park money in the short term, are all participants in the money market. Some of these wholesale transactions end up in the hands of investors as components of money market mutual funds and other assets. Now let's get into who uses the money market. Commercial paper is a popular borrowing option in the wholesale market since the interest rates are very high than most bank deposits or treasury bills, and there is a wider choice of maturities available from ranging from overnight to 270 days. Commercial paper, on the other hand, has a far larger chance of default than bank or government assets. Individuals can acquire money market funds, short-term certificates of deposit, which you can also call CDs, municipal notes, or U.S. Treasury bills to invest in the money market. Individual investors can access the money market through local banks and the U.S. government Treasury Direct website. Another way to invest in the money market is through brokers. Treasury notes, which have maturities ranging from a few days to a year, are issued by the U.S. government on the money market. Primary dealers purchase them in bulk from the government to trade among themselves or sell to private investors. Individual investors can purchase them directly from the government through Treasury Direct a bank or a broker. Short-term notes are also issued by state, county, and municipal governments. Money market aims for stability and security by never losing money and maintaining a $1 net asset. The expression "break the buck," it refers to when the value goes below the $1 NAV threshold, implying that some of the original investment is lost and investors will lose money. However, this scenario occurs seldom since many money market funds are not FDIC insured, which means that money market funds might lose money. Let's get into money market versus the capital markets. When you're dealing in debt with a maturity of less than 1 year, it is referred to as the market. Governments and companies utilize it to keep their money flow stable, and investors also use it to make a little profit. The capital market is where debt and securities are bought. The word capital market refers to the stock and bond market as a whole. While anybody may purchase and sell a stock in a fraction of a second these days, businesses that issue stock do so to raise funds for long-term operations, while the value of a stock might vary. Unlike many money market, it never expires. The money market is critical to a contemporary financial economy's proper operation. It allows people to lend money to individuals in need of short-term loans, putting resources the most productive use possible. Governments and banks require these loans to satisfy short-term obligations or regulatory requirements. They were recently issued overnight. At the same time, it provides opportunities for people with spare cash to earn money. It is also ideal to place your money in liquid assets. The money market is uncontrolled and unstructured market. Money markets provide a lot lower rate for investors to earn. It is more simple to withdraw money. Money markets, they may be different from capital markets, and that way they usually for a more little period of time. Now let's get into dollar cost averaging. It's an approach that can be used to mitigate the impact of price risk while purchasing stocks. Exchange traded funds or ETFs, also mutual funds, is known as dollar cost averaging. With dollar cost averaging, you do not make a single investment in a single item at a single purchase price. Rather, you divide the total amount of money you wish to invest in by very little amounts of the asset over a period of time at regular intervals. This decreases the likelihood of overpaying for anything before prices on the market decline. In point of fact, price movements do not always proceed in the same direction. On the other hand, making a number of smaller purchases rather than one large improves the likelihood that you will end up paying a lower average price overall. In addition, dollar cost averaging enables you to put your money to work on a consistent basis, which is critical for the growth of an investment portfolio over the long term. Market timing versus dollar cost averaging. The value of an item often increases over time, which is why dollar cost averaging is effective. On the other hand, the value of assets do not increase in a linear fashion during the short term. They focus instead on short-term highs and lows, which may or may not follow any pattern at all. A lot of people have been trying to time the market by making strategic purchases of assets at discounted rates. In theory, this should be a rather straightforward endeavor to complete. It is quite difficult to accurately forecast how the market will behave in the short term, even for experienced stock pickers. It's possible that this week's low will turn out to be quite a bit higher than it is today. In addition, the peak reached this week might look like a steal in a month from now. In hindsight, you are the only one who can establish what a reasonable price would have been for a specific item. Nevertheless, by that time, it is too late to make a purchase when you were and try to time the acquisition of an item. You frequently find that you end up purchasing it at a price that has leveled off after the asset has already achieved large gains. This is how it is controlled. Using dollar cost averaging removes the element of emotion from the investment process by mandating consistent purchases of a small quantity of the asset over time. When prices are high, you buy a smaller number of shares when prices are low. You buy a larger number of shares. Let's assume that you have decided to invest $1,200 in a mutual fund. This year, you can either choose to invest all your money at once at the beginning of the year or at the end of the year. You can choose to invest $100 each month. Even though it might not appear that picking one strategy over the other would make much of a difference, if you buy shares in increments of $100 a month for a year, you might end up with more of them than if you bought everything out all at once. This can happen if you spread out your purchases over the course of a year. Approach known as dollar cost averaging enables investors to begin their portfolios with relatively modest sums of capital. It's possible, for instance, that you don't have a large sum of money available to invest all at once. The process of investing using the dollar cost averaging strategy entails consistently Placing smaller amounts of money into the market. This is done on a regular basis, and this method you won't have to wait until you accumulated a larger sum of money before you can profit from the expansion of the market. Using dollar cost averaging to make consistent investments ensures that you will continue to make investments regardless of the state of the market is in. Keeping assets even while the market is down can be a nerve-wracking experience for some people. If you decide to cease investing or pull out of your current investment while the market is weak, you run the risk of missing out on potential future gains. Who ought to make use of the dollar cost averaging method? If you are just starting out with investing and you have limited amount of money available to put towards stock purchases, you should think about using dollar cost averaging. Not interested in all the research that goes into determining the best time to enter or exit a market. Making consistent investments in retirement funds on a monthly basis, such as an individual retirement, IRA, or 401k, unlikely to maintain investing in weak markets. If you have a substantial sum of money to invest, you might find that another investment approach better suit your needs. Through a taxable brokerage account, you are participating in mutual funds that demand a larger starting contribution from investors at the outset. You don't mind spending extra time and effort researching the market since you enjoy trying to time the market correctly. You are investing with a focus on the near future. Risk is possible that using a dollar cost strategy would be beneficial, but you should be aware that doing so is not risk free. Before you start putting money into the stock market, there are a few things you should think about. It is a good idea to give some thought to the level of risk that you are willing to assume, as well as the aspects of the problem that are best suited to your area of expertise. In addition, it is not a good idea to invest money that you might require in the not too distant future, or to place yourself in a situation that might put you in a financial bind. Both of these things could be disastrous for your financial situation. It all starts with determining what kind of investor you want to be in the first place. Economic risk that might be also something you keep in mind. The risk is that an investment made in a foreign nation faces as a result of changes in business circumstances or the negative impact of macroeconomic variables. This risk can occur as a direct result of changes in business circumstances of microeconomy. Both engage in business and investing one's financial resources are inherently risky activities. It is notoriously difficult to forecast the effects of economic risk. Even while the sky at home or in a certain country overseas could be sunny and full of promise right now, ominous clouds could quickly roll in and completely transform the current state of the commercial landscape. In the context of project financing, the term economic risk refers to the chance that the project production may not have a sufficient market value to pay for the project's ongoing operation and maintenance expenses. In addition to the obligation associated with the project's debt servicing, there are also different types of economic risk. There are a number of factors that can influence economic risk. However, the possibilities that are given below are not exhaustive. Here's some of the categories that can be used to classify financial risk. Risk to the sovereign because the repercussions of this kind of economic risk might lead to extra difficulties for the company. It is one of the most dangerous dangers that can have a direct impact on an investment. The possibility that a nation's government will be unable to honor its financial obligations and will therefore fail on payments is referred to as sovereign risk. When a nation's government becomes bankrupt, it has a direct on the businesses that operate within that nation. The term sovereign risk refers to more than simply the possibility of a nation failing to meet its obligations. It also encompasses the possibility of political unrest and shifts in the policy of the nation. Alterations in government policy have the potential to have an impact on the exchange rate of a currency, which in turn can have an effect on the transaction of a corporation, potentially resulting in a loss when a profit was anticipated. Let's talk about risk in the exchange rate that was not expected. This type of sovereign risk takes place if there is a significant shift in the market, which result in a fluctuation in the currency rate. When there is a great deal of volatility in the stock market, it has an effect on the internal trade. This may be the result of a speculation over a particular commodity or currency, or it may be the result of news regarding a commodity or currency. Or a process have the potential to have a significant impact on the movement of markets for other traded items. As was mentioned earlier, market movement can be negatively or positively affected by acts taken by the government. Alterations in inflation, interest rates, tariffs on imports and exports, and tax rates all have an impact on the currency exchange rate. Exchange rates can give the impression of being a significant threat to the economy due to the direct impact they have on commercial activities. There's also risk to the credit. This particular of sovereign risk is characterized by the likelihood that the counterparty will be unable to fulfill its commitments due to the fact that credit risk is based on the ability of another company to repay its debt. It is entirely impossible to regulate. It is necessary to conduct routine audits of the business operations of the counterparty in order to guarantee that all business transactions are finished on time and that there is no risk of counterparty being unable to make payments. Let's talk about some downsides and disadvantages. It is possible for economic risk to bring about the failure of not just the company, but also the market as a whole. Although it is possible to lessen the impact of economic risk, this risk cannot be eliminated totally. Economic risk has an effect on international trade and has the ability to have an effect on the commercial activities of all players that is both long-term, long-lasting, and significant. The economic risk that is the most difficult to foresee, and as a result, the economic risk that is the most difficult to decrease or devise strategies to reduce is tough. Economic risk, like any other kind of risk, can be mitigated through the use of investment vehicles such as international mutual funds, which offer diversification to investors by enabling them to put their money into a variety of different things all at once. Purchasing insurance that covers damages that come from a counterparty's failure to satisfy their obligations is another way to lessen the economic risk that you are exposed to. Hedging your activities against swings in the exchange rate will be helpful and will help lessen the risk. Before selecting whether or not to move forward with a new project, it is essential to investigate the potential risks, and one should move forward only if the potential risks are outweighed by the anticipated anticipated profits to an adequate degree. Even while most people think of economic risk in relation to doing business or investing in another country, it is possible for economic risk to arise right in your own backyard. The term country can refer to any nation, including the one you live in. The risk that a company's performance could suffer as a direct result of variations in the value of its currency or of changes in the regulations that govern business in the country in which the company operates. Hazards to the economy might potentially have a devastating effect not only on enterprises but also on individuals. A person's financial security could be jeopardized in a number of ways. That includes the possibility of losing their employment, seeing a decline in the value of their investment, or even being involved in an extraordinary event such as an accident. Everything can be managed successfully if proper precautions and preparation are taken. It is important for businesses that are susceptible to economic risk to be abreast of current events that may have either a short-term or a long-term influence on their operations. Alterations in the reserve rate set by the Federal Reserve or unfavorably news could have an effect on markets located all over the world. It is important for an entity to have an up-to-date information on the activities of any foreign entities. Because of this, the company will have an easier time monitoring its various activities. There is also a potential for financial loss if the money is invested in a business enterprise from another country. As I said before, a range of different factors might have an effect on the economy, on the economic risk. To effectively mitigate economic risk using a strategy, one needs relevant domain expertise. A large number of investors who enjoy taking risks put their money into an enterprise that is exposed to the possibility of economic loss. Investors who are willing to take risks are considered to be investors. On the other hand, investors who are unwilling to take unnecessary risks will restrict their holdings to the domestic market. This risk can be reduced by employing a number of different technological, uh, technological approaches. However, any such reduction will incur expenses. Hedge fund, which the phrase hedge fund does not have a clear definition under either the federal or state regulations governing securities. In their most basic form, hedge funds are just private investment pools catering to wealthy, well-informed individuals. Histor- Historically, they have been structured as partnership organizations. The general partner, sometimes known as the managing member, is the individual who is responsible for managing the fund's portfolio, which includes making investment decisions and, in most circumstances, investing their own money in the fund. Many managers of hedge funds set their sights on achieving a particular level of performance and work hard to generate satisfactory returns regardless of the underlying market fluctuations. In order to achieve this level of performance, hedge fund managers frequently apply a variety of sophisticated investing strategies and procedures which are described in more detail below, which I'll get into. Private hedge funds are typically exempt from the requirements of registering with the U.S. Securities and Exchange Commission, which is also called SEC, because they are only available to a select group of wealthy and financially savvy investors. They are generally not allowed to advertise publicly offer their securities, and they generally do not have to as a direct consequence of this. Unregistered private hedge funds do not make available to their investors a significant number of the safeguards that are standard for registered investment products. The usage of single manager hedge funds could lead to reduced diversification, greater volatility, and increased firm-specific risk. This is due to the fact that these funds only invest in one manager. Investors should keep in mind that privately offered alternative investments such as hedge funds are only available to persons who are accredited investors or qualified purchasers within the meaning of the United States security laws, are speculative, involve a high degree of risk, and may have substantial charges. Additionally, these investments are appropriate only for the investment of an investor's less liquid capital portion of their portfolio. Before you decide to follow the advice I've given you, you need to give some thought to a number of variables, including the following: the possible downsides, upsides, and upfront and ongoing expenses associated with purchasing and later selling of securities, your age, other investments, financial condition and needs, tax status, investment objectives, investing experience, investment time horizon, liquidity needs, and risk tolerance. The goal of the investment, the characteristics of the assets, including any qualities that are particularly unique or distinctive, its liquidity, its volatility, and the expected performance of the security under a variety of market and economic situations when dealing with complicated products. You should think about it if less complicated or expensive products can accomplish the same goals. By indicating that you are satisfied with your consideration of the aforementioned reasons by accepting a recommendation, you agree that you have done so. Risks that are unique to concentrated hedge funds and funds with a single manager. The following dangers are unique to concentrated and single manager hedge funds and apply to them exclusively. Less diversity. Concentrated hedge funds will have less diversification than other types of hedge funds since they do not allocate as much of their assets to as many underlying funds or investment managers. This danger is bigger for single manager hedge funds, greater volatility due to the fact that concentrated hedge funds use a fewer number of managers. And they also often have a greater amount of return volatility than their less concentrated counterparts. This danger is even bigger for single manager hedge funds. Greater risk particular to each firm. Concentrated hedge funds will deploy their capital to fewer investment managers, which will result in an increase in the total amount of risk connected with each firm. This danger is even bigger for single manager hedge funds. Particular dangers posed by cryptocurrency funds. There are dangers that are unique to Bitcoin funds, just like there are risks associated with other kinds of privately provided funds. A few examples of such dangers are, I'm going to give you a few examples of these type of dangers. Regulatory alterations or actions taken by regulators could have a negative impact on the nature of an investment in the Bitcoin fund. Technology. If network protocols are not adequately monitored and kept up to date, this could cause a harm to the networks and have a detrimental effect on the value of the underlying cryptocurrencies. Also, cybersecurity. Unsavory actors might conspire to take control of the processing power of the networks, which will have a negative impact on the value of the cryptocurrency that corresponds to it. In adoption, there is no assurance that any particular cryptocurrency network, or even any of them, will continue to expand or succeed in gaining widespread acceptance. The price of cryptocurrencies has historically been extremely volatile in comparison to more traditional asset classes, which poses no a significant market risk. Liquidity or private placement arrangements should not be used to actively trade cryptocurrencies, and the lack of daily or monthly liquidity may limit an investor's ability to sell their holdings at any given moment in time. Trading cryptocurrencies should be done through a public exchange. The requirement of both an encrypted key and a password in order to gain access to one cryptocurrency holdings is a risk for investors who choose to engage in cryptocurrencies. Loss of encrypted key is another risk associated with investing in cryptocurrencies. If the encrypted key that the fund manager keeps in the name of the fund were to be misplaced or compromised in any other way, then the fund manager would no longer be able to sell or transfer the digital currency that was attached to that key. This would make it impossible for the fund to continue operating. If the key is misplaced or stolen, it is possible that the ability to sell items or transfer money will be lost permanently. Regarding the tax burden, in general, investors in hedge funds are required to pay income taxes on any interest, dividends, or capital gains that are delivered to them from the fund. On the other hand, taxes are not withheld from retirement funds such as individual retirement accounts, which is also called IRAs, until the account owner takes distributions from the account. Because of the complicated tax reporting requirements, as well as the fact that neither Wells Fargo advisor nor its affiliates are qualified to provide tax or legal advice. You should discuss the tax implications of investing in hedge funds with your own personal tax or legal advisor in order to gain a comprehensive understanding of these implications. According to the Internal Revenue Service definitions, hedge funds have the potential to generate unrelated business taxable income, which is also called UBTI or IRS. UBTI refers to the revenue that an organization receives from a trade or business that is not substantially related to the basis for the organization's exemption. This applies to the majority of organizations. This may result in the taxation of a tax deferred account, such as a retirement plan or an individual retirement account, as well as tax-exempt entity, such as a foundation or an endowment. When tax-sensitive funds are offered for tax-deferred accounts or tax-exempt corporations, you are strongly advised to think about the possible benefits of using one of these funds as a part of your hedge fund allocation. Before making any decisions regarding your investment, you should discuss the possibility of UBTI with your tax professional. It is important to consider the potential tax repercussions of each investment you make. And hedge funds and funds of hedge funds are two types of investments that could fall into this category. When contemplating an investment in hedge funds or funds of hedge funds, one must be aware that there are a variety of unfavorable tax repercussions that must be taken into account. Stock funds gives investors access to the world's largest and most liquid equity market, as well as the option to buy ownership in some of the most successful companies in the world. Stock funds also provide investors with the ability to diversify their portfolios because many of these United States shares have historically achieved good risk-adjusted returns. Domestic stock funds have traditionally formed a significant component of many portfolios with long-term high horizons. This is the nature of the investments. When you put your money into a domestic fund, it is combined with the money of other investors and put toward the purchase of shares of stock issued by companies based in the U.S. It is hard to get such a diverse portfolio of stocks and shares by shopping for them one at a time, as it is as is the case with most types of mutual funds. Although all domestic stocks funds make investment in companies situated in the United States, the strategies that are followed by the funds might be very different. Some funds concentrate on businesses that fall within a certain range or have a particular market capitalization, while others look for businesses that invest in a specific manner, such as growth or value. Other funds might have a broader investment strategy, with an emphasis on capital appreciation, current income, or a combination of the two, rather than a particular market capitalization or investment approach. It is a common practice for these funds to make equity investments in companies operating in a wide variety of markets, geographic location within the U.S., and types of economy activity. The first thing you need to do in order to choose the fund that are going to help you achieve your financial objectives is to gain an understanding of the investment strategies, as well as the potential dangers that comes with investing in local stocks. There are also many um, domestic stock funds. Investors can gain access to the world's largest and most liquidity user funds. This gives investors the opportunity to purchase shares in some of the most profitable companies in the world. You also have the option to have distribution of dividends and capital gains automatically reinvested in the fund, which can compound over the course of time and help enhance long-term returns. Additionally, you are free to make new investment at any time. The required minimum initial commitment for the vast majority of stocks funds is likely to be significantly lower than the cost of constructing a diversified portfolio of an individual stock. The dangers of investing in domestic stock funds: loss and value of the principal. The success of every stock fund is determined by how it is holding and individual stocks perform. When there is a general decline in the value of equities, the value of an investment fund, we also see a decline. It is important that you know a stock fund will focus on a certain area of interest. It may, it may be, for instance, invest just in companies listed on the FTSE 100, or it could concentrate on investing in small cap companies. The funds take on different levels of risk depending on the stocks in which you invest. It's possible that a fund has a high level of risk if the majority of its holdings are startup business, but it could have a low level of risk if the majority of its holdings are in blue chip companies with consistent returns. The primary advantage of purchasing shares in a stock fund is that it enables you to diversify your holdings by providing access to a large number of stocks in a single transaction. And on the other hand, you will be required to pay fees in order to support the fund's ongoing maintenance. Prior to making a decision to invest, it is essential to give careful consideration to both the benefits and drawback of purchasing shares in a stock fund. As an investor, you owe it to your future self to have an in-depth graph of benefits and drawbacks of stock funds, as well as the ways in which you avoid or reduce the negative effects of
Thank
drawbacks.
you guys for tuning in my channel. And please like, comment, and subscribe. And don't forget to turn on your notification bell. See you guys next video.